Hello, my name is Eddie Tofpick. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London, UK feed wheat. Paris milling wheat. In late May, prices moved down and away from arguably the most difficult overhead congestion on my daily chart, between 267 to 270, where the market was capped and turned into a V-top. Prices headed lower within a June-based, quite acute bear channel, exiting out at the gold long moving average, currently at 225, with nearby influence from the significant supports at 227, the now flatlining medium moving average, currently 235, the bright red neckline extension of the June to November 2023 head and shoulders top, currently at 237, and under the overhead congestion between 238 to 242, containing the March 2013 high at 240. Of all these, the two most important were and are the bright red neckline extension and the gold highlighted long moving average. The market had in recent weeks hesitated, dipped, then pulled back, forming a dark blue late June to date bear channel, currently 201 even to 223, verging on being a descending expanding wedge pattern. For this reason, I said here 10 weeks ago, and I quote, V-tops such as this one here sometimes form a handle or sideways action, usually a pennant or a bear flag on the way lower. Sometimes, and this is rare, they form a flat rectangle. End of quote. The pressure in any V-top with an extension would be for lower prices, and so we saw an attempt lower in late August, eventually making a small V-bottom, which was, interestingly, after this week's action, cut off as an island bottom, with two changeover gaps highlighted on my daily chart, one in early August and one this week. The gapping move higher this week overcame the 50% absolute Fibonacci line at 219, the dark blue upper trend line of the descending wedge pattern, as well as the flatlining short medium moving average, currently 223, and the long moving average. The 50% absolute Fibonacci line and these moving averages are now considered supports. We then had a fairly free area until we come up today to two principal resistances, the flatlining medium, mauve medium moving average and the bright red neckline extension. These stand in the way of a number of potential pattern targets, and there's quite a few of them. They are target X at 238, the primary target for the descending wedge pattern, target X1 at 327, the primary target for the island bottom, and target X2 at 241, the combined secondary target for the descending wedge pattern and the island bottom. The only issue is that they mostly are within a 238 to 242 congestion band, containing the March 2013 high at 240. However, should prices overcome these, then we not only will fill in the small gap left over from the changeover from mid-June between 242 and a quarter to 242 and 3/4, but we may also have a fairly free area overhead up to another congestion band between 252 to 255, possibly extending down to 250. Last week, I was, as I said at the time, and I quote, right now I am still not convinced of the strength and validity of this recent rise. I'm still not convinced of the strength and validity of this recent rise, and I will be watching closely to see if what I suspect may be true, end of quote. Well, this week I am more sure of the attempt higher than I was last week, but it all depends on what prices do with the mauve medium moving average and the bright red neckline extension. Coming to a very interesting period now. Minneapolis wheat. Back in late February 2023, and especially at the start of April last year, so that is now outside the parameters of my daily chart, the market constructed a large bear channel that morphed into what is now my daily chart, a descending expanding wedge pattern, currently 676 to down well off the bottom of my daily chart. The upper trend line is currently escorted and reinforced, and has been for some time, though not very well recently I have to say, by the declining long moving average, currently at 669. I've kept this breached, large, original descending wedge pattern still on my daily chart, as the others that were here, originating from August, September and October 2023 through to April 2024, have all been thoroughly broken, and this largest one is still here, even if it was breached, as a just-in-case situation. Going back to the market action, prices turned low of a V-top at the end of May, heading down to a very narrow and acute bear channel. The market exited out of this pattern at the start of July, held up by a combination of the October 2018 high at 611 and the April 2021 low at 606, and most importantly on approach to the green highlighted September 2019 to date uptrend, currently at 594, which held things up despite what turned out to be a breach in the middle to late August. During the course of its time being held up, the market created what initially looked like, and still does, a more or less dark blue sideways expanding wedge pattern, currently 576 to 670. However, within this expanding wedge pattern, the market also created a cat's ears pattern over July. The pattern was triggered 3 weeks ago, but failed to reach down to its target below, instead turning back up short of it, back up within the dark blue expanding wedge pattern, and over the breached green uptrend, and importantly, back up over the neckline for the cat's ears pattern. Last week I said of this move back up, and I quote, "It has not been enough, not yet at least, for me to consider this to be a fresh move higher. Overhead we now have the congestion from January to March 2021 between 625 to 650, with congestion at 635, a congestion band between 650 to 656 containing the mauve medium moving average, currently 652, congestion between 666 to 676 containing the dark blue upper trend line of the expanding wedge pattern, the May to August 50% Fibonacci line at 669, and the long moving average, currently also 669. All these are also within a wide congestion band pre the mid-year V-top formed between February to April, between roughly 635 up to the May 2021 low at 676. End of quote. I further added, and I quote, "These last 2 weeks have been a significant recovery. I've seen a significant recovery, but I have my doubts about the stability and the sustainability of this rise right now. I'm not writing it off, but I think it will need a lot more convincing for me to see this as a significant move higher. I'll be watching this market closely." End of quote. Nothing there has changed, and even I surprised myself by looking at Minneapolis as being the odd one out, when so many times it has been the leader. London UK feed wheat. I'm sorry that this daily chart is so colourful, messy and condensed, but there is a lot going on here in a relatively narrow range. The bullish incentive was eroded through May, enough that we saw the creation of a V-top pattern with a very sharp downward slope that became, and here's the leap of faith, I'd previously actually asked you to make on my commentaries here, and I do so again this week. The V-top became a V-top with a ghost extension that was caused with the changeover in early July. The construction of the second part of this V-top was a very late May to late June, very acute and narrow bear channel. This bear channel overcame all the congestions on the way down except the one at 164.95, just above the combined lows of July 2021 and May 2023 at 164 even. This congestion caused the market to exit out the small bear channel. We then had a changeover gap, a large one, between 170.40 to 196.45, and have since created a descending wedge pattern, currently 181.95 to 185.55, highlighted in purple on my daily chart. In mid-August, prices dropped down away below this pattern, but have not really moved away from it, and I will deal with this shortly. But first I'd like to talk about the big, and it is a big leap of faith. It is to imagine this descending wedge pattern tacked onto the end of the small bear channel, and thus we would have, as we have seen elsewhere in the other grain markets, a V-top with an extension. Only here in truth it's not. Nevertheless, there was, from the break lower in mid-August, potential for lower prices, possibly as far as the June low at 164.95, and prices tried, but had limited success. The primary target was achieved, but not the harder to reach secondary target, though we did see it for a while, the market under the bright red middle time, currently 176.15, of the recent May to early July bearish shift pitch. However, prices recovered higher. Now last week I stated, and I quote, "Though we have bounced, it looks right now like a bounce that may not be sustained, hence watch those supports again closely in case we see them tested, as below these, especially below the bright red middle time, we have the dark blue lower tie, currently 173.65, of the significant early March to late June bullish Andrews pitchfork. This last dark blue pitchfork is the only bullish pattern, bar I suppose the gold long moving average, which is flatlining anyway, left on this daily chart unless the market chooses to construct a new pattern. End of quote. Thus, we now have below some immediate support from the September 2021 low at 181.70, the 50% absolute Fibonacci line at 180.5, the combination of the March to May 50% Fibonacci line at 178.25, and the gold flatlining long moving average, and that's currently at 178.40. We are today piercing and trying to stabilize over the purple upper trend line, currently at 185.55. of the descending wedge pattern, as well as the dark blue medium moving average, and even trying to do the same over the green short medium moving average. Unlike most of the other grains, I am not sure of this current move higher. What I mean is that not that I doubt it, just that I am here I'm not sure. You see, we have relatively little in the way topside until the crossover of the dark blue middle tine, currently 194.20, and the bright red upper tine, currently 193.95. Now, as I said elsewhere, watch out for volatility around tine crossovers. Usually I apply this to tine crossovers of the Andrews and Schiff pitchforks for the same move, which is an important point. However, I'm not being so strict here, so I just say caution on this. By the way, the next crossover of sorts is on the 27th of September. Possibly mark that in your diaries. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.